Hello, my name is Benjamin Tan, and I'm the Securities and Education course, i.e. the SEC co-lead lecturer. SEC is student-led course run by the Investment Society, and welcome to the SEC Winter Special, which is the 20-minute condensed bite-sized version of the lecture for you to brush up on your knowledge in the winter holiday.
Hello, my name is Sebastian Stewart, and I'm the co-lead lecturer along with Ben. The SEC is a finance lecture series based on the CFA Level 1, covering a range of topics ranging from equities to real estate to FX and many more. This lecture series is ideal for beginners as well as advanced and intermediate students. We hope you enjoy listening to the podcast as much as we enjoyed delivering the lectures. Thank you for all those who attended the course this year. We had a record level of registration and hope to welcome more of you next year.
Hello, my name is Louis, and I'm the co-producer of IIIP. This lecture is part of a SEC lecture series conducted by the SEC team. But due to the winter break, I'll be the one who's distributing this lecture. So here we go. Fixed income. Fixed income is the world's largest asset class. With an estimated value over $200 trillion globally, it is almost 3 times the size of combined global equity market valuation. Fixed income refers to any type of investment under which the borrower or issuer is obligated to make payments of a fixed amount on a fixed schedule. For example, the borrower may have to pay interest at a fixed rate once a year and repay the principal amount on maturity. The foundational fixed income security is the bond. There are many different types of bonds with various structures and uses. Fixed income is much less risky than equity investments and generates a steady source of income. Depending on the terms, bondholders may also have to complete downside protection. So what are the bonds? Bonds essentially represent a loan that has been turned into a security which can be traded. A government or corporation borrows money from investors and issues bond in return. The bonds represent the commitment by the issuer to repay the principal at maturity as well as interest payments at fixed intervals. The bonds fall under the 2 main categories, sovereign and corporate. A sovereign bond is a debt security issued by a national government to raise money for financing government programs, paying down old debt, paying interest on current debt, and any other government spending needs. Sovereign bonds can be denominated in a foreign currency or the government domestic currency. A corporate bond is a bond issued by a corporation in order to raise debt. Companies use the proceeds from bond sales for a wide variety of purposes, including buying new equipment, investing in research and development, buying back their own stock, paying shareholder dividends, refinancing debt, and financing mergers and acquisitions. Now let's talk about the bond characteristics. Due to the nature of bonds and their issuance, each bond will be different from the next in terms of legislation and terms and conditions. However, all bonds have the following characteristics that help investors and institutions understand the risk and return potential of a given bond. The maturity. This is the date when the principal of the bond is paid back to bondholders and the company's bond obligation ends. Therefore, it defines the lifetime of the bond. A bond's maturity is one of the primary considerations an investor weighs against their investment goals and horizons. Next is a secured or unsecured. A bond can be secured or unsecured. A secured bond pledges specific assets to bondholders if the company cannot repay the obligation. This asset is also called collateral on the loan. So if the bond issuer defaults, the asset is then transferred to the investor. An MBS, which stands for mortgage-backed security, is one type of secured bond backed by titles to the homes of the borrowers. Unsecured bonds, on the other hand, are not backed by any collateral. That means the interest and principal are only guaranteed by the issuing company. These bonds return little of your investment if the company fails. As such, they are much riskier than secured bonds. Liquidation preference. When a firm goes bankrupt, it repays investors in order of the capital stack as it liquidates. After a firm sells off all its assets, it begins to pay out its investors. Senior debt is debt that must be paid first, followed by junior debt. Equity holders get whatever is left. This includes investors holding shares. Bonds are typically a senior debt, hence their low relative risk compared to other derivatives. The coupon rate. The coupon amount represents interest paid to bondholders, normally annually or semi-annually. To calculate the coupon rate, divide the annual payments by the bond principal. Tax status. While the majority of corporate bonds are taxable investments, some government and municipal bonds are tax-exempt, so income and capital gain are not subject to taxation. Tax-exempt bonds normally have a lower coupon rate than equivalent taxable bonds. An investor must calculate the tax-equivalent yield to compare the return with that of a taxable counterparts. Last is the callability. Some bonds can be paid off by an issuer before maturity. If a bond has a call provision, it may be paid off at earlier dates at the option of the company, usually at a slight premium to the principal. A company may choose to call its bonds if interest rates allow them to borrow at better rate. Callable bonds also appeal to investors as they offer better coupon rates. The next thing we have to discuss is risks of bonds. Bonds are a great way to earn income because they tend to be relatively safe investments. But just like any other investment, they do come with certain risks. Here are some of the most common risks with these investments. Payment risk. Payment risk is the risk that a given bond issue will be paid off earlier than expected, normally through a call provision. This can be bad news for investors because the company only has an incentive to repay the obligation early when interest rates have declined substantially. Instead of continuing to hold a high-interest investment, investors are left to reinvest funds in a lower interest rate environment. Next is the interest rate risk. Interest rates share an inverse relationship with bonds, so when rates rise, bonds tend to fall and vice versa. Interest rate risk comes when rates change significantly from what the investor expected. If interest rates decline significantly, the investor faces the possibility of repayment. If interest rates rise, the investor will be stuck with an instrument yielding below market rates. The greater the time to maturity, the greater the interest rate risk an investor bears, because it is harder to predict market developments further out into the future. Next is a credit default risk. Credit or default risk is the risk that interest and principal payment due will not be made as required. When an investor buys a bond, they expect the issuer will make good on the interest and principal payments, just like any other creditor. When an investor looks into corporate bonds, they should weigh out the possibility that the company may default on the debt. This includes looking at the bond rating. Safety usually means the company has a greater operating income and cash flow compared to its debt. If the inverse is true and the debt outweighs available cash, the investor may want to stay away. Bond ratings. Most bonds come with a rating that outlines their quality of credit. That is, how strong the bond is and its ability to pay back its principal and interest. Ratings are published and are used by investors and professionals to judge their worthiness. Next important topic is the bond yields. Bond yields are the measures of return. YTM, which stands for yield to maturity, is the measurement most often used, but it is important to understand several other yield measurements that are used in certain situations. YTM is the most commonly cited yield measurement. It measures what the return of a bond is if it is held to maturity and all coupons are reinvested at the YTM rate. Because it is unlikely that coupons will be reinvested at the same rate, an investor's actual return will differ slightly. Next is the current yield. The current yield can be used to compare the interest income provided by a bond to the dividend income provided by a stock. This is calculated by dividing the bond's coupon by bond's current price. Keep in mind, this yield incorporates only the income portion of the return, ignoring possible capital gains or losses associated with the principal. As such, This yield is most useful for investors concerned with current income only. Next is the nominal yield. The nominal yield on a bond is simply the percentage of interest to be paid on the bond periodically. It is calculated by dividing the annual coupon payment by the principal value of the bond. It is important to note that nominal yields does not estimate return accurately unless the current bond price is the same as its principal value. Therefore, nominal yield is used only for calculating other measures of return. Also, there is a yield to call. A callable bond always bears some probability of being called before the maturity date. Investors will realize a slightly higher yield if the called bonds are paid off at the premium. An investor in such a bond may wish to know what yield will be realized if the bond is called at the particular call date to determine whether the prepayment risk is worthwhile. Last, we have annual realized yield. The realized yield of a bond should be calculated if an investor plans to hold a bond only for a certain period of time rather than to maturity. In this case, the investor will sell the bond, and this projected future bond price must be estimated for the calculation. Because future prices are hard to predict, this yield measurement is only an estimation of a return. The next topic we have to discuss is bond spreads. The yield curve. For a bond that has a lifetime of 1 year after issue, the yield is quite low. This is because the bond doesn't last very long, so the issuer has little incentive to compensate the bondholder for a year's worth of debt. For successively longer bond lifetimes, the yield tends to increase. These types of yield curves are known as normal yield curves. We would expect most yield curves to curve upward since the longer you hold the bond, the greater the return and hence the greater the YTM. Sometimes this might not be the case. Instead, the yield curve could flip, giving instead an inverted yield curve. Inverted yield curves indicate recessions. Investors want to be guaranteed a safe return on their investment in bonds, so they'll buy long-term bonds if they believe a recession is coming. Even if a recession does happen, the central banks might have to lower the interest rates, and that would make the current long-term bonds even more desirable due to their higher coupon rate. To compensate for this, the central bank would have to negotiate higher yields in a bid to ensure people to buy up their bonds, and the government has enough money on its hands to deal with an oncoming recession, hence the inverted yield curve. Because government can easily pay off any bonds it issues owing to its taxation system, corporations have to entice investors with yields much higher than those that the government is offering. As a result, the corporation bonds exist on a yield curve much higher than treasury bonds. For this reason, we also name treasury bonds benchmark yield curves. Next, we have to discuss about the yield spreads. Corporate bonds versus treasury bonds can cause a few questions, including the way we compare them. Investors tend to use two metrics to solve this problem, G spreads and Z spreads. Let's discuss these in turn so we know what they mean. Let's start with the G spread. G spreads are the simpler ones to explain. Essentially, you are measuring the difference in yields between the corporate bond you are looking at and the corresponding treasury bond for a given duration before expiry. The G in the G spread simply stands for government spread. Often this spread can be written as YC minus YG, where YC is the corporate bond yield and YG is the government bond yield. Sometimes it is possible that the maturity of a corporate bond doesn't match any government bond you find. In this case, you would have to use a linear interpolation to get around the problem in finding a value for YG. Next is the Z spread. Remember calculating present value of equities in the other lectures? You can do the same with the bonds too. The trouble is that the numbers we might use as a discount rate will vary as the rate of return changes in line with the interest rates offered by treasury bonds. To solve this, we might match the discount rate with the YTM of a zero coupon bonds. However, this can lead to another problem. Sometimes the spot rates of, example, the T-bills may misprice a bond such that the present value of a bond is far higher than the market rate. Say that there existed a 4-year 10% coupon rate on a £100 corporate bond which was trading on the market for £127. And if we use the current spot rate to calculate the present value for the bond, we might get something very different answer from that. So by adding certain number to the current spot rate, we can match the calculated present value and the market value of the bond. So this added number is called the z-spread. Professionally, it is referred to as the spread that must be added to each spot interest rate to cause the present value of the bond cash flows to equal the bond's price. And so why bonds over equities? In general, investing in debt is relatively safer than investing in equity, and in turn the returns differ considerably. That's because debt holders have priority over shareholders in the capital stack. That is, if a company goes bankrupt, most if not all funds accrued through the liquidation of assets will go repaying the debt holders, including the bondholders, leaving little not no reimbursement for the equity partners, shareholders for example. In terms of risks, bonds from developed governments, treasury bonds, are considered risk-free as the entire economy of the country who issued the bonds would have to collapse and the nation declare bankruptcy for the bonds to default. While not exactly yielding high returns, in 2020, a 30-year U.S. Treasury bond yield an interest rate of about 1.7%. There are cases where bonds yield much higher rates and are more attractive investment. For example, the current yield of the same 30-year U.S. Treasury bond is about 3.79%, over double of that 2020. This is because the inflation crisis we are facing and how that translates to rising interest rates. When a government wants to bring down or control the inflation, they raise the interest rate due to COVID, the energy crisis, and the Russian-Ukraine war in 2020 has been unprecedented soars in inflation across the globe, with most countries being hit regardless of their economic size or position. In an attempt to control this inflation, governments, most notably the US, UK, EU, and Brazil, have hiked their interest rates by a massive amount almost monthly, leading to some of the highest interest rates ever. Bond prices are inversely proportional to interest rates. When interest rates rise, the bond prices drop. That is why we are seeing such unusually high yields in the bond market. As discussed in previous section, currently yield would rise if bond prices drop. Aside from making bond prices low and yields high, rising interest rates raise the cost of capital, so other investment tools become less attractive due to rising costs and higher risks. Occasionally, yields can spike to very high levels due to the underlying bond price crashing. This happens at times of uncertainty and instability in the market. Most recently, the UK's 10-year gilt saw yield spike tremendously due to the crashing of the pound in late September and the new government's controversial tax cut plans. Stocks will outperform bonds in the long run. However, bonds outperform stocks at certain times in the economic cycle. It is not unusual for stocks to lose 10% or more in a year. So when bonds make up a portion of a portfolio, they can help smooth out the bumps when the recession comes along. Also, in certain life situations, people may need security and predictability. Retirees, for instance, often rely on the predictable income generated by bonds. If your portfolio consisted solely on stocks, it would be quite disappointing to retire 2 years in a bear market. By owning bonds, retirees can predict with a greater degree of certainty how much income they'll have in their later years. An investor who still has many years until retirement has plenty of time to make up for any losses from periods of decline in equities. The interest rates on bonds are typically greater than the deposit rates paid by banks on saving accounts. As a result, if you are saving and you don't need the money in the short term, bonds will give you a relatively better return without posing too much risk. Bonds from stable governments and large corporations like Apple, Google, Amazon are best investment tools for capital preservation. However, keep in mind that although bonds are safer, that does not mean they are all completely safe. There are also very risky bonds, which are known as junk bonds. We also have asset-backed securities. Asset-backed securities allow their issuer to raise cash. The underlying assets of an ABS are often illiquid and cannot be sold on their own due to their risk. So pulling assets together and creating a financial instrument out of them, a process called securitization, allows the issuer to make illiquid assets marketable to investors. The underlying cash flow obligation can come from many different industries and types. Usually a security is made up of only one family of underlying assets. There is also a collateralized loan obligation. A collateralized loan obligation, which is a CLO, is a type of a security that allows investors to purchase an interest in a diverse portfolio of corporate loans. The company selling CLO will purchase a large number of corporate loans from borrowers such as private companies and private equity firms and will then package those loans into a single CLO security. Collateralized mortgage obligation. Collateralized mortgage obligation consists of several tranches or groups of mortgages organized by their risk profiles. The tranches typically have different principal balances, interest rates, maturity dates, and potential of repayment defaults. Collateralized mortgage obligations are sensitive to interest rate changes as well as to changes in economic conditions such as foreclosure rates, refinance rates, and the rates at which properties are sold. Each tranche has a different maturity date and size, and bonds with monthly coupons are issued against it funded by the mortgage repayments made on the underlying asset. Lastly, we have a collateralized bonds obligation. A collateralized bond obligation is an investment-grade bond that is backed by a pool of junk bonds. Because the pool includes several types of credit quality bonds together from multiple issuers, they offer enough diversification to be structured as investment grade. Lastly, we have roles of bonds in a portfolio. Investors include bonds in their investment portfolio for a range of reasons, some of which we have already briefly touched on. First is income generation. Bonds provide investors with a source of income in the form of coupon payments. The investor can use income generated by their investment for spending or reinvestment. Shares also provide income in the form of dividends. However, such payments are less certain and tend to be less than the bond coupons. Capital preservation. Unlike stocks, principal value of a bond is returned to the investor in full at maturity. This can make bonds attractive to risk-averse investors who are concerned about losing their capital. Capital appreciation. Although bonds are often viewed as a capital preservation tool, they also offer opportunities for capital appreciation. This occurs when investors take advantage of rising bond prices by selling their holdings prior to maturity on the secondary market. This is often referred to as investing for total return and is one of the more popular bond investment strategies. Hedge against economic slowdown. While investors in stocks typically do not welcome slowdown in economic growth, it can be a good thing for bond investors. This is because slower growth usually leads to lower inflation, which makes bond income more attractive. An economic slowdown may also be negative for company profits and stock market returns, adding to the attractiveness of bond income during such a time. And finally, diversification. Bonds are considered a defensive asset class because they are typically less volatile than some other asset classes, such as stocks. Many investors include bonds in their portfolio as a source of diversification to help reduce volatility and overall portfolio risk. And this is all for the fixed income, and thanks for the listening. And once again, this is Louis Kim, the co-producer of IP. Thank you.
Credit to our producers, Aaliyah Friedman, Louis Kim. Head of Marketing, Samhat Raman, Juniors, Ken Zhang, Angie Zhao. Head of Scriptwriting, Alfred Choi, Juniors, Aditya Muthakumar, Kwan Lin. Head Liaison, Lucrezia Poloni, Junior, Ekaterina Vitor. Head of Audio, Isaac Chu, Junior, Cyrus Lee. Head of Sponsorship, Sami Liu and Vladimir Dmitriev. Juniors, Leo Lee, Jamila Tabet, Utkarsh Jetli.